Today we'll be presenting on Chile's capital control strategy in the 1990s by Group F.
So hi everyone, I'm NURUL SYUHADA. So let me begin by introducing the focus of today's presentation. So Chile approach to capital control during the 1990s. So during this period, Chile stood out among developing countries for how it tackled the growing challenges of financial globalization. And rather than fully embrace unrestricted capital flow, Chile adopted a more cautious and strategic approach. One of core instruments it used was the unremunerated reserve requirement, or known as URR. So this tool was specifically designed to discourage short-term speculative capital inflow, often referred to as a hot money, without affecting long-term productive investment. So the main goals behind this policy were threefold. First is to maintain macroeconomic stability, second to control inflation, and third to protect the economy from external shocks. So what makes Chile case unique was its ability to strike a balance between openness and control. They allow for growth and investment while still safeguard its monetary policy and exchange rate stability. So through the presentation, we will explore the rationale behind these controls, how they were designed and implemented, and most importantly, what outcomes they produce for Chile's economy. And finally, we will look at what lessons other emerging economies can learn from Chile's experience, especially in manage their capital flow during the volatile periods. So now let's look into the economic background that shaped Chile's decision to adopt capital controls in the 1990s. From 1932 to the early 1970s, Chile functioned as one of the Latin America's more stable democracies. But economically, the country experienced inconsistent growth and structural challenge. So then came a turning point in 1970 when President Salvador Allende introduced a socialized policies. This included nationalizing industries, controlling price, and boosting public spending. While this move initially stimulated the economy, they quickly led to the hyperinflation, massive fiscal deficits, and economic instability. By 1973, the economy was in free fall. The same year, a military coup brought General Augusto Pinochet to power. Under his regime marked a radical shift. Chile embraced free market reforms, many of them inspired by the Chicago Boys. Between 1975 and 1981, Chile cut tariff, privatization more than 400 state firms, opened up its capital account, and fixed its exchange rate using the so-called tablita systems. Initially, this approach worked. Inflation fell and growth returned. So by 1982, Chile was hit by a deep financial crisis. The country had accumulated too much external debt. Its currency was overvalued, and the banking sector was poorly regulated. So the result, GDP collapsed by more than 10%, unemployment jumped to 20%, and the government had to nationalize much of the banking sector. So this became a defining lesson in the dangers of unchecked liberalization. So in the late 1980s, Chile began to recover through better fiscal discipline, stronger financial oversight, and a growing export sector. By 1990s, it returned to the democracy and maintained its open market-driven model. But a new challenge emerged: large and volatile capital inflows. So these flows threatened the country's monetary independence and create pressure on the real exchange rate. So that's when Chile introduced the exchange policy in 1991, a form of capital control aimed at filtering short-term inflows while keeping long-term investment attractive. Understanding this economic history from crisis to reform is essential to us. So it's explained why Chile pursue capital control, not out of isolationism, but out of a desire to navigate the impossible trinity, maintain a fixed exchange rate, and allowing capital mobility, and preserving an independent monetary policy. So here I show you the graph of the real GDP growth in Chile from 1970 to 1990, which clearly illustrates the key economic phases and the sharp contraction during the 1982 debt crisis. So let's now take a look at to this graph. As you can see, in the early 1970s, under the President Salvador Allende's socialist policies, the economy faced deep structural problems. As you can see here at point 1973, growth turned negative and inflation skyrocketed, setting the stage for the 1973 military coup. Following that, during the late 1970s and early 1980s, under General Pinochet, Chile adopted aggressive market reforms. They prioritized trade liberalization and a fixed exchange rate. So this period, they saw the strong growth average around 6 to 8% annually. It was celebrated as the Chilean miracle. However, this boom was short-lived. In 1982, Chile suffered a massive financial crisis triggered by excessive foreign borrowing, weak financial regulation, and an overvalued currency. Notice the sharp dip here at the point of negative 10.3% in 1982, GDP contract by more than 10%. So the crisis led to soaring unemployment and bank failures. So this has posed the danger of rapid liberalization without institutional safeguards. And the recovery efforts began in 1984 with a more stable fiscal policies and better regulations. As you can see here, it's consistent growth returning towards the late 1980s as Chile prepared for its democratic transition. So this graph not only tells us as a story of growth and crisis, but also they illustrate how macroeconomic policies and capital flows directly impacted to the Chile's real economy. So these experiences strongly influenced Chile's cautious approach to capital control in the 1990s. So that's all from me. I will pass to the next presenter, ERLYNA, to discuss further on analysis on capital inflow and also the policy reaction. Thank you.
Hello, my name is ERLYNA HAFIZ. So, for this part, I'm going to explain what happened to the Chile in the early 1990s and why the country faced a serious problem because of capital inflows. So, let's take a look at the first bullet. So, did you know during that time, Chile economy was strong, the country was stable politically, and global interests were low. So, because of that, many foreign investors see Chile is a good place to invest their money. This made a big increase in foreign capital inflows, especially hot money. So, what is hot money? Hot money is mean a money that come in very fast and can leave just as quickly. As I mentioned in the bullet 2, it usually goes into the portfolio investment, such stock, bonds, or a short-term loan, which is not a kind of money used to build a business or factory. It's a short-term, very flexible, and can be dangerous for a country economy if not managed carefully. At the first, this inflow helps Chile. They bring in more money, increase investment, and add to the country foreign reserve. But soon, the problem started. Let's take a look at bullet 3, which is one of the major issue was the appreciation of the Chilean pesos. When investor brings more money into the country, they need to exchange their foreign currency into a local currency, where this increase a demand for the peso, making a value goes up. But when the peso gets strong, export become more expensive, and that hurts a local business who sell to a foreign market. This is called the Dutch disease effect. It means when too much foreign money make export less competitive. So at the same time, as stated in the bullet 4, the capital inflow increase the money supply in the country. This causes inflation, meaning that the prices of goods and services are started rising. So now, here's where the problem gets more complicated. The central bank want to control inflation, but if they raise the interest rate, that will attract more capital inflows and make the peso strong. This situation is called a monetary policy dilemma. This dilemma is a part of something economists call the policy trilemma. It means that country cannot have all three of these at the same time, which is a fixed exchange rate, a free movement of capital, and a full control interest rate. This country can only choose two, and they make a policy decision very difficult. So if you look at figure 1, you can see how the peso appreciate between 1990s and 1992. The line in the graph goes up. That means like the peso becomes strong. This trend is one of the reasons Chile needs to take action. Also, as in the last bullet, the economy was showing sign of overheating. That means a lot of money coming in too quickly that leads to a rapid growth, rising prices, and a risk of financial bubbles. If the situation was not managed carefully, it might lead to serious economic issues. Actually, Chile did not want to fully close economy, but they know they need to slow down these short-term inflows. So that's why it's introduced a new policy, which I will explain with the next part. Hello. Moving on to this part, which is 2.2, implementation of the Engage. So yeah, in June 1991, Chile introduced a smart policy called the Engage on Unremunerated Reserve Requirement, URR. So basically, this policy did not stop a foreign capital coming in, but it works like financial filters that make a short-term investment less attractive. Here is how it works, as I state in the bullet 2. If a foreign investor wants to bring in a capital, especially short-term loan or bonds, they had to deposit 20 to 30% of that money into the central banks for 1 year, and they will not earn any interest on it. So basically, they lost some money. That make a short-term investing in the Chile's less profitable. So, but this policy was not meant to block all foreign investors, where FDI was excluded. FDI stand for the foreign direct investment. So that means investors who want to build a factory, open businesses, or do a long-term project were not affected. Chile still welcome long-term investor. That what I can say is Chile's like a serious investor for a long term. So the purpose, as I state in the bullet 4, was to change the composition of the capital's inflow, which is to reduce hot monies and increase stable long-term investment. So now, how we know the policy works? We can look at the figure 2, which shows the inflation rates in Chile from 1990 to 1998. So in 1919 and 1991, inflation was hiked over 20%, but after the Engage was introduced in June 1991, inflation started to go down. By 1998, we can see it was below 7%. This shows the policy helps reduce inflations. Next, let's look at the bullet 6. The Engage also helps the central bank control interest rate in inflation without causing the peso to appreciate more. So the last point is Chile was using a crow-line exchange rate band. This means the peso was allowed to move, but only slowly within a controlled range. This system needs stability, and the Engage helps the reducing sudden capital inflows. So the Engage was not a block; it's just a smart filter. It keeps the economy open, but protect it at the same time. Moving on to this. So 2.3 is about policy objective of the Engage. So now let me explain the main objective of the Engage policy. So the first goal was to reduce the risk from the monies where can cause inflation, hurts export by making the peso too strong and suddenly leave the country with causing instabilities. By making short-term capital more expensive, the in-cash helps reduce this risk. So the second goal was to encourage a long-term investment, especially in important areas such infrastructures, manufacturing and export industries. These types of investment are more stable and support long-term growth. So that's why FDI was not affected. Chile still welcome long-term investor. The third goal was to protect Chile's monetary autonomies, meaning that the central bank can still manage interest rate and inflation without worrying that rising rates will attract more foreign money. So the policy gave the bank more freedom and flexibilities to manage the economy. The in-cash also fit well with the semi-fixed exchange rate system where the peso can move slowly in a set range. So the policy helps protect the system by controlling sudden capital surge. So overall, the in-cash was not about blocking a capital but about managing it smartly. Chile stay open to the world but protect its economy. It's balance economy openness with financial stabilities.
Okay, so now I'll be discussing about the policy effectiveness. So the question, did the NKJ work? It partially is effective in managing capital flows, achieve a goal of reducing short-term speculative flows, and encourage long-term capital inflows with more stable impact. So next, positive outcomes. It helped strengthen monetary control during period of high inflows, contributed to macroeconomic stability by reducing capital flow volatility, and supported policy efforts to prevent currency over valuation. Okay, so now moving on to the next part of policy effectiveness. First off, we have limits of effectiveness, temporary impact, investors adjusted behavior over time, capital still entered via alternative channels such as derivatives, trade finance, and offshore borrowing. Next, we have trilemma insight. Highlights the policy trilemma, which also known as impossible trinity, cannot maintain fixed exchange rate, free capital movement, monetary independence. Mind you, only two can be achieved at once. Okay, so now I'll be discussing about the policy challenges and loopholes. First off, we have policy evasion, use of derivatives, trade finance channels, offshore borrowing. Next, we have higher borrowing costs. Financial institutions transfer costs to businesses, reduce credit access for smaller firms, and may slow domestic investment. The third point, we have key implications, confirms policy trilemma constraints, trade-offs between control and openness, and challenges for macro financial stability. The fourth point, we have investor confidence, reduced trust in policy consistency, concerns over regulatory uncertainty, and risk of capital flight due to unpredictability. Last point is enforcement limitations, difficult to monitor all capital movements, loopholes in financial regulations, and limited reach of domestic controls in global markets. That is all from me. Thank you.
My name is Muhammad AMMAR, so I will continue with the lesson learned, recommendation and conclusion. So, what Chile's experience with capital controls? The first one, they use unremunerated reserve requirement, which is URR, to manage short-term capital inflows. Next one, they control were targeted, temporary and well communicated, and minimizing disruption to long-term investment. So the next one, they also aim to reduce currency appreciation, curb asset bubbles, and maintain monetary independence. Other than that, they prove more effective when paired with other macroeconomic tools. So for the next slide, why Chile's control were relatively successful? Here we have 4 strong points, which is the first one, credible central bank. The strong institution, autonomy and inflation targeting regime boosted trust, and transparent policy communication, which is they minimize uncertainty and capital flight. Other than that, macro-prudential toolkit, they use function intervention, reserve buffers and capital inadequacy norms. And for the last one, they created a stable environment for foreign and domestic investors alike. So here are the recommendations for modern emerging economies. So the lesson for today, emerging markets, is temporary and targeted capital controls can reduce volatility without discouraging investment, and complement control with macroprudential policies like liquidity coverage and debt limits. And it also strengthen institution credibility to reinforce investor confidence, and also ensure policy transparency and consistency to avoid market panic or regulatory arbitrage. So after all of that, for the conclusion for this slide is balance, openness and stability, neither full liberalized nor overly restrictive, and demonstrated values of smart, responsive financial governance in managing capital flows. In a world of rising global shocks, institution strength and policy flexibility are the key. And for Chile's example, controls can work if used wisely, sparingly, and within a credible framework.